Are you trying to understand about what's going on in the Australian housing market? Dive in as we give insights in the RBA, the Big Four, and what the fixed rate mortgage cliff means to you as a home buyer or even a mortgage owner. The Reserve Bank of Australia is working closely to control inflation. We've seen them watch the economy recently, holding the cash rate for the last two rate decisions. And if inflation continues to rise, we might see the Reserve Bank quickly increase interest rates. The rate reductions might not happen until 2024. And we've got the Big Four banks and what they're going to do and what their predictions are coming up soon.
Yeah, it has been really confusing. Pretty much for the last year, a lot of banks have been saying, we're almost at the top, we're almost at the top. They've kind of been boiling that frog and saying like a little bit. And rates have kept going up. They haven't come down yet. And a question I've been asked almost every week for the last year is, when are rates going to come down? When's it going to go back to how it was?
All right, let's start off with what the big banks are predicting, starting off with Commonwealth Bank of Australia. They predict 4 reductions from March of next year, aiming to get the cash rate to 3.1% by the end of next year.
So that's almost a 1% cut from where we're at the moment. Westpac are saying 6 rate cuts are going to start from pretty late in 2024 from September, leading to a cash rate of 2.6% by 2025.
NAB is predicting 1 more increase this year, with cuts beginning in 2024 and 2025 to reach the cash rate of 3.1%. Now that's a 1% cut. Remember guys, the cash rate's at 4.1%, so we can see the banks are predicting quite significant rate cuts to start next year.
And ANZ are saying there could be a single 0.25% cut anticipated in the later part of 2024. So it's interesting, all these banks are saying the rates are potentially going to start coming down at some point in the future, but it's dependent on so many factors. And interestingly, I don't know if you've read some of the banks' massive profits, some of their annual reports are coming out. A lot of them are complaining about their net interest margin. So that's the difference between what they're paying sort of depositors, the people that get the money from, and then what they're lending the money out to the mortgage holders. And they're saying, well, that margin's getting squeezed and squeezed and squeezed. So what we have seen in previous rate cutting cycles where the banks start to, or the Reserve Bank cuts the rate, the Reserve Bank might cut the rate by 0.5%, by 0.5%, but it's not to say that the banks are going to pass on the full amount. If the Reserve Bank cuts by 0.5% and the banks only pass on 0.25%, they keep that 0.25% as extra profit, as extra net margin, and it helps sort of stabilize them, goes into their profit, and helps them for the future.
And that's where, as rates start to come down, it might be worth looking at reviewing your finances. That's called the loyalty tax, where the banks charge a higher rate for an existing customer compared to a new customer. Interestingly, Jaden, we've also seen a lot of the fixed rates come down recently. So previously, a 2-year fixed rate was coming in at the high 6s. Now they're coming in at the low 6s. So that sort of gives us an indication where the markets are starting to think that we might be close to the peak of the cycle.
So the RBA has been using the cash rate as a bit of a blunt instrument to control inflation, because in their view, the more they increase the cash rate, the more expensive things get, and people hopefully slow down spending and spend less and stop the price of things from going up. So the current rate of inflation is 6%. And the Reserve Bank has increased the cash rates multiple times, trying to get that inflation rate from 6% to their target range of 2 to 3%.
Now, the Reserve Bank doesn't expect inflation to hit target until 2025. And that's, as we saw in December of last year, inflation reached a 33-year high record at 7.8%. Now, some of the factors that contributed to this record high inflation was the war in Ukraine, the pandemic-induced supply chain disruptions, strong post-pandemic demand in Australia, and wage increases that led to higher costs passed on to consumers. And if you do find value in this video, please consider doing me a little bit of a favor and hitting that subscribe button, as it really does help out the channel. And a big thank you to all our subscribers for your support. Inspires us to create more content. We hope you enjoy. Now, Jaden, we saw CoreLogic discuss the impending fixed rate mortgage cliff in February of this year, and it was predicted that 1.3 million home loans were going to transition from ultra low fixed rates to high variable rates. As of this month in August, we're in the peak transition period, and the housing market performance is under scrutiny. The risk in the housing market is being assessed as the majority of fixed rate loans taken out during COVID are expiring.
Yeah, there has been some slowing in economic activity. Housing momentum has slowed because of these higher rates, and increased new property listings have slowed. But they are saying the risk of defaults and arrears is still pretty low.
Now, the fixed rate mortgage cliff refers to a significant number of fixed rates expiring, mostly secured between mid-2020 and 2021. Fixed rate lending surged during the pandemic, peaking at 46% of new home loans secured during this period. Now, to give you a bit of perspective, usually 15% of new home loans are fixed in. So it went from 15% to 46% of total home loans written opting for ultra-low fixed rates, and now they're due to expire. Now, the primary risk for borrowers is that they're going to be struggling with the higher variable rates once their fixed rate ends. Now, to give you a bit of an example, the average loan taken in May of 2021 has a monthly increase on their repayments of nearly 6% from when they go from their low fixed rate to their variable rates.
Now, majority of housing debt now is on variable rates. Variable rate borrowers have been exposed to all the cash rate increases, because if your rate's variable, every time the banks or the Reserve Bank increases your rates, your repayments re-increase. But even so, arrears remain in check and below pre-pandemic levels.
Now, housing costs and living expenses are putting pressure on borrowers, and Westpac Consumer Sentiment recently came out with their August edition showing there's a decline in sentiment amongst mortgage holders. And remember to like, share, and subscribe if you do find value in these videos.
So the increase in cash rate has mean increasing housing costs, have reduced extra payments into the offset and some of the buffers people had. And as a result, retail spending volumes really fell in the June quarter. The pace of CoreLogic's housing increase has slowed, but interestingly, new listings increased by 2.8% in July, which is a bit of an unusual trend. People tend to find and move and list properties in the spring months. But from what we've heard on the ground from a lot of our clients, a lot of our borrowers that are out there looking, there's still not a lot of new stock hitting the market. Why is that?
Yeah, definitely. Look, we've got a lot of clients that are pre-approved. They're super keen to buy, but there's just not enough property. There's not enough stock on the market. And that's probably why CoreLogic has noted that property prices have remained stable, if not slightly increased. There's just still the same amount of demand, lower supply. So that's increasing prices ever so slightly. So it's a real interesting sort of dynamic that we're in at the moment. Rates have increased by over 4% in the last sort of 12 to 18 months, and we're still seeing property prices hold up. So really interesting to see what's happening there.
Yeah. So interestingly, there hasn't been this big rush of people distressed selling. They're holding onto properties, or if they bought them 2, 3, 4 years ago, they've actually got quite a bit of equity in there, and their loan's relatively small compared to the levels today. So there haven't been those distressed sales, properties hitting the market and selling at a huge discount.
Now, the other thing about these rate rises is they don't impact the economy equally. So for example, the borrowers that purchased in the last 2 years feel the real brunt of these rate impacts far more than someone that's owned their property for 10, 20 years that might have a smaller mortgage. So unfortunately, it's unequally distributed amongst the community, and usually it's the younger borrowers that are hit the hardest because they're the ones that have most likely entered into the market more recently. So something that we'll keep a close eye on, particularly with the Reserve Bank and where they're going to go with cash rates and how that's going to affect the market, especially as a lot of these fixed rates are ending. These increased repayments are certainly going to impact the bottom line.
So the question that's going to be happening, and we're going to be asked probably more and more in the next few months, is now the time to fix? And this is where it gets trickier moving forward. You might start to see the fixed rates get lower than the variable rates because the banks are saying, well, in 1 or 2 years, we know the cash rate's going to come down. And that's where it gets tricky. Do you go variable? Do you go fixed? And here at Hunter Galloway, that's where we can help. We help home buyers and mortgage holders across Australia. If you've got a home, if you've had a home for a couple of years or looking to refinance, we can help. Hit us up at huntergalloway.com.au.
Or call us on 1300 088 065. Guys, as always, thanks for watching, and we'll see you next time.